My name is Jared Ogle, and today I'm going to be talking to you about signal processing in the stock market. So we're mainly going to be talking today about technical analysis and technical indicators to use. What technical analysis is actually looking at the stock chart and identifying patterns within it and making informed decisions on where that price movement is going to go based on those indicators. The main indicator that is used is moving averages. It's the bread and butter of a lot of other indicators. It's basically the average price within a specific time period. It can be analogous to a low pass filter because it highlights the longer term trends, and by doing that it smooths out the curve within a stock chart. Similar to how a low pass filter might highlight the lower frequencies and attenuate the higher frequencies. Usually a long-term moving average is compared to a short-term moving average to see when those two intersect, and that is how decisions are made. You have a simple moving average and an exponential moving average. The exponential moving average is just a simple moving average but with weighted values on each price for higher weighting on the prices that are closest to today's current date. RSI is the relative strength index. It's a ratio of the average gain over the average loss and scaled from 0 to 100. So that's what this equation is saying right here. It measures the change and speed of change in the price movement, also working as a filter to highlight quick, aggressive price movements in the market. Typically a threshold of 70/30 is used to determine if a stock is overbought or oversold, similar to how a cutoff frequency might be used. The MACD is a moving average convergence divergence indicator. It's basically just two moving averages, a long term and a short term, and you use it similar to how you would use a moving average. Bollinger Bands are more moving averages, so you have your middle band, which is just your regular moving average, and then you have an upper and lower band, which is K times N period standard deviation above or below the middle band. How traders use this is they monitor the widths of the band. So as the bands widen, volatility is increasing, and so thus the existing trend may be over. And as the bands tighten, volatility is decreasing. So the likelihood that a sharp movement will happen is high. For FFT analysis has been researched in stocks. But it has been proven not to be very useful in actually predicting the movement because FFT analysis, it aims to break down waveforms, repetitive waveforms into harmonic components. So it relies heavily on cyclical patterns. And as we know, stocks are very random. They don't have very easily defined patterns of movements. So a cyclical type of analysis doesn't work very well for stocks. It can be useful for other financial applications, such as like interest rates or inflation. Fibonacci retracements is another tool very highly used in stock trading. Basically, it's based on the Fibonacci sequence of numbers. So you start with 0 and 1, and then every number to the right of that is a sum of the two numbers to the left. And then we get the ratios, the Fibonacci ratios, by taking the numbers and dividing it by the number to the right, or dividing it by two numbers to the right, or dividing it by three numbers to the right. And these ratios just give insight into the support and resistance levels that a stock will trade off of. So this is our stock chart right here. We are currently looking at a 5-day period. If we look at this, we'll notice that the white line is the long-term SMA line. The gold line is the short-term SMA line. Don't pay attention to the gray part. That's after hours, and most traders can't trade in that time. Our red and purple dotted lines are the Bollinger Bands. Down here is our RSI, and below that is the MACD. So just looking at the SMA lines, the gold and the white, we're looking for times when they cross over. So when the gold crosses below the white line, the price trend is downward. And when the gold crosses above the white line, the price trend is upward. So right here, we can see the gold cross below the white line, and our price trend is downward, indicating a downward price trend. And as we can see, that downward price trend shows itself in that day. So the whole day we have a downward trend. Same thing for right here. The gold crosses below the white, and then we have a downward trend for that whole day. Over here we have the gold cross above the white, indicating that we have an upward trend. And as we can see for that whole day, we had an upward trend. Looking at the Bollinger Bands, we're just going to look at this one specifically. It's this kind of thing does repeat itself later, but if we look right here, they start to diverge right about here, indicating that there's a lot of volatility. The more they diverge, the more that movement is going to slow down. Right around here, they go around about the same pace. So now they're not converging or diverging. And as you can see around there, it starts trading sideways. Once it starts to tighten up right here, that's indicating that there's going to be a sharp movement in either direction. And as we can see right around here, we see a sharp movement in the upward direction. If we were to look at the RSI, we're just looking for points when it was oversold or overbought. So when it's red or blue, light blue, the points when it was oversold, we can see the price bounce off of a low and then shoot back up. So that happens right there. We can also see it happening right here and right here. We see it. This is where it's oversold right here, and the price shoots back up. We can also see it when it was being overbought. So it was being overbought right around here, and the price shot back down. So if we were going by the RSI, we should be due for a price movement downward. To look at the Fibonacci retracements, I already have it set up on my cursor right now. So you take the beginning of the movement, go to the end of the movement, and then we look at where it's going to retrace. So if that's our movement right there, we can see that this is our first level of resistance. And as you can see, that was consistently a level of resistance until about right here, where it broke through, and then our next level of resistance became our next Fibonacci level. These patterns happen often in trading. Just to give you another example of the Fibonacci retracement indicator, we'll look at another movement. So if we want to look at it from, we'll go back to this one. So if we take it from right here to about right there, we can see the price kind of just jump in between these first two support and resistance levels. The moment it breaks above that, it's going to keep breaking above that. In this one ticker, it pretty much jumped the whole Fibonacci ratio, and then the next ticker jumped 2 Fibonacci ratios. We can still see the resistance levels are where the Fibonacci ratios are. This would be the very last Fibonacci ratio, so it would be the very last spot for there to be a resistance. And so it's kind of indicative of the strongest resistance Fibonacci ratio wise. And so we can see the chart bouncing off of that level.